Hello everybody, my name is Les Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. First, a piece of good news. Thank you for your support. I have reached over 1,000 subscribers on the YouTube channel, helping people with their finances, and I am looking forward to the next 1,000. Now, with the new year coming, I thought I would share some things I do on December 31st and on January 1st of 2024. I'll mention some other things that people do or experts recommend. First on my list are the fun and high level items. So first we check the net worth. Mine has gone up by about 260,000 this year, so not bad. I review my portfolio returns in absolute, meaning dollar terms. The portfolio value went up from 3,867,000 at the start of the year to 4,449,000 at the end of the year, which is about 582,000 increase. To reconcile this with my net worth after removing the 435,000, which were the proceeds from the last investment property sale, and were reinvested into the stock market, I am up about 147 in my portfolio share prices since the start of the year, plus another 120,000 in dividends I was paid and spent. The difference is the remainder of the investment property realtor fees, as well as the taxes I owe from the sale, which I tracked. Also, compare your portfolio against benchmarks. Qtrade has a nifty tool where you get a letter grade, and I mostly want performance and some income. I am also beating the TSX handily in the long run with my stocks, so that's not bad. For your mutual funds, go to morningstar.ca and make sure the funds are 4 or 5 stars, and the mutual fund, even after fees, seen as the blue line, is beating its appropriate index, the red line, and other mutual funds investing in the same area, the yellow line, as your fund. Review the last year's spending, budget for next year. The only trouble spot is the taxes for me, which will be much less next year since I will not be selling any houses in 2024. My strata fees went up significantly and are higher than I budgeted for, and I had dental work done while I was traveling because it was cheaper to get a crown done in Thailand. So I went over the budget there as well. Some other things to do. Wait for January 1st, 2024 to invest a fresh 7,000 into the TFSA, all in one lump sum if you have it. Before December 31st, if you need any cash out of the TFSA, pull it out now so you get the limit back January 1st when it recycles, so you don't have to wait a year to get the limit back. Plan your year in taxes. Are you going to sell something? Make sure you know what effect that has on your taxes. People think about taxes in March or April because it's an unpleasant subject, and they wait until they are doing their taxes for the previous year. But keep in mind, you need to take action during and before the end of the calendar year the taxes are for. Before the end of the 2023 calendar year, some things to consider would be: check how much income and capital gains you will have this year and next, and consider selling investments this year or delaying the sale until the next year, depending on which year will have less income. If both years have roughly the same expected income, you may wish to delay selling something that has appreciated until next year, so you have to pay taxes a year later on that investment. If you need to rebalance your investments or have had significant capital gains this year, consider the tax loss selling strategy, see a previous video, and take into account the items above. Do any tax loss selling, which is selling investments with unrealized capital losses, which can be used to reduce any capital gains already realized in 2023. Sell these now so you see the transaction settle and complete by Friday, December 29th, so you can offset any capital gains this year. Losses can also be applied retroactively to gains realized during the 3 previous years or carried forward indefinitely. With tax loss selling, the selling transaction must settle before the last business day of the year. Given a 3-day settlement period, this implies the deadline is before Christmas Eve, but why push it? In addition, you should be aware of the superficial loss rules. For example, do not repurchase the losers within 30 days before or after the sale. So consider repurchasing something similar but not identical. If you sell a security to trigger a loss and you or an affiliated person, for example, your spouse, a corporation you control, or a trust where you have a major beneficial interest, including an RRSP, purchases an identical security within 30 calendar days before or after the sale, and the person still owns that security 30 calendar days after the sale date, then the capital loss is denied to you by the CRA and added to the cost base of the person who bought it. This rule also applies if you or the affiliated person buys an option or a right to buy the security that was sold. For example, shares of competing companies within an industry should not be considered, quote, identical securities, while an index fund which tracks the same index would be considered identical securities for purposes of the superficial loss rules. Please note that the capital loss will be denied if the buyer of the property is an RSP under which the seller or seller's spouse or common law partner is the annuitant. Therefore, swapping or contributing eligible securities to an RSP will result in the denial of a capital loss, even though accrued capital gains would be taxable. The idea of tax loss selling and harvesting is to think of the stock being worth whatever it is at the time, with you being able to take some advantage now of the loss. If you think it will recover, you can buy it back later, and if it goes up, you'll worry about the capital gains taxes later when you're ready to sell it. If you don't think it will recover, take advantage of the tax loss and use the money from the sale on something you think will go up. There's no point holding on to it, hoping it will recover, just so you feel better about your investing decision, since it will just get worse as it goes down. So that is the way of thinking about the capital loss selling. You're taking advantage of the loss while you can. Moving on from tax loss selling, if you are looking at buying mutual funds at this time of the year, you will want to delay until January. Mutual funds make distributions by law of any gains they have had internally, and while this isn't actual cash and doesn't affect the share price in the long run, you get taxed on the distributions without actually receiving any, so you don't get any benefit. So delay until January to make large purchases of mutual funds. Also, get ready for RSP season if you need to buy more RSPs for 2023, with the deadline being the end of February, and consider starting a monthly purchase plan for your RSPs rather than just during RSP season, so you get the money appreciating all year. If you are buying RSPs all year, which you really should be, don't have to do anything at this point. Otherwise, prepare for RSP season and make sure you buy by the February 29th, 2024 deadline. In case your payroll department does not know about your RSP purchases, meaning you didn't make your RSP purchases through the company, fill out a T1213 request to reduce tax deductions at source form in January, so the CRA can let your payroll department know to withhold less taxes from you, so you are not giving the government an interest-free loan all year with a big tax refund at the end. I know the big tax refund feels really good in terms of cash flow, but you did not have that money accessible to you the entire year. Rather, the government had it with an interest-free loan. Turning to RSPs, for those of you with children, if you have RSPs for your child, try to make sure contributions of the $2,500 happen to max out the 20% government grant under the Canada Education Savings Grant CESG program at $500. You can catch up next year, but where entitlement is carried forward, the total CESG per beneficiary per year is capped at $1,000, or 20% of the unused CESG room, whichever is less. Moving on to charitable giving. If you are planning on doing any charitable giving or have other tax deductions you can trigger, do so now to get the tax credit a year sooner. Check your fees. Your brokerage or financial advisor will give you disclosures in time for your taxes, usually with your tax documents or with your statements, to tell you how much fees you have been charged. Take a good look. On January 1st, start exporting transactions out of your trading or bank accounts for your taxes, organizing statements for your accountant, even though mine wants an extra 2 weeks before and 2 weeks after the year in the statement. Looking at goals, have some, post them somewhere. And if you like to do New Year's resolutions, sure, do New Year's resolutions. Make a plan to invest monthly. If you're not investing, start now. Save a certain amount by doing something specific differently. Most people do general goals like lose weight or do better with money, and surprisingly, nothing comes of it, and they stop trying 2 weeks into the new year. Make the goals SMART, where SMART stands for specific, or simple, sensible, significant. M is for measurable, also meaningful and motivating. A is for achievable, or agreed and attainable. R is for relevant, also could be reasonable, realistic, and resourced, or results-based. And finally, T is time-bound, or time-based, time-limited, time cost limited, timely, or time-sensitive. For those of you who have exchange-traded funds, find the ETF adjusted cost base after distributions for the year. Your ETFs get distributions in the calendar year that you will be paying taxes on, so you need to increase your adjusted cost base on the ETF by the amount of the distribution so you don't pay tax on the distribution and keep the same adjusted cost base, which would amount to double taxation. So there's lots of things you can do at the end of the year. Some need to be done in the calendar year. Others are just a good thing to do, and you might as well do them while you're doing the necessities. Some of the things I mentioned can't be done until January, but you can do things for just entertainment value on New Year's Day. So that concludes what I do on December 31st and January 1st. If you have any requests on what you would like me to cover in future videos, please put that in the comment section. If you'd like to get in touch, please reach out on any of these social media channels, and may you have a profitable day.